Hello, welcome to another episode of Emergent Investments. This is the podcast that explores the growing opportunities in GP-led secondary markets with the Emerge9 team and key industry partners and thought leaders. We have another one of those thought leaders with us today. Aman Verji is someone I met when he arrived on the Stanford campus 30 years ago. He's one of those people that I quickly noticed had a very large brain. Of course, everyone at Stanford was at least base level intelligence, but there was a handful of people who really stood out for having really keen analytical minds. Aman has applied that keen analytical mind to everything from the Academy Awards to fantasy football, but primarily he's focused on markets, investing, venture capital, growing companies, help advising companies how to make them grow faster, get to revenue profitability faster, and so on. Has a storied career. We'll get into that in a moment. Of course, those of you who were with us for our first two podcasts, this is episode 3, know that I have to first satisfy a legal requirement here. So allow me, if you will, to just read a brief disclosure statement. Emerge9 does not make investment recommendations for any securities. Alternative investments are generally illiquid and involve significant risk. There is no guarantee investors will recoup their investment, and the entirety of the principal is at risk. It is the responsibility of any investor to carefully review relevant deal documents and consider all associated risks, costs, and expenses before making an investment. Furthermore, broker-dealer services are provided by Finalis Securities, LLC, a FINRA SIPC member. Emerge9 and Finalis Securities, LLC are separate and unaffiliated entities. And with that, legal requirements satisfied, let's get into it with Aman Verji. Aman is the co-founder and co-GP of Practical Venture Capital, which was founded in Palo Alto in March of 2019. So they're about 3.5 years into it. Before that, he worked at a VC firm called 500 Startups, which was a very active firm in the Valley, funding a lot of great companies. As I say, Aman has a undergraduate degree from Stanford and is also a graduate of Harvard Law School, where he also taught economics for a time. So we're very privileged to have someone with his mind and his perspective on the podcast today. Aman, why don't you tell us a little bit about Practical Venture Capital and what you guys are about and what you do, and how over the past 3.5 years you've seen, you guys specialize in the secondary market as well. So I'm curious to know how you've seen that. Obviously, the last 3.5 years have been pretty eventful, both in the world and in the Valley. We've had a massive run-up in valuations that has since, over the last 10 months or so, started correcting. But I'm just curious to give us a little bit of the origin story of PVC and what it is that you guys do over the past 3.5 years, and where you see it going from here.
Yeah, happy to do that. So as you said, we are a Silicon Valley venture capital firm. You might ask, why am I wearing a cowboy hat? I am in Austin, Texas today. So we're doing some meetings and some fundraising and checking out the Austin community. Like many in the Bay Area, we're pretty active investors in really all over the country and represent investors from all over the country. So I figured, being in Texas, I was going to wear my hat today. I was wondering if I can prove that I'm in Texas if I try this. The stars at night are big and bright. Yeah, that definitely.
I can vouch for him being in Texas because I was in Texas with him over the weekend. So we were in Dallas then, but he was definitely there, and we
absolutely
definitely had a good time.
Little Pee Wee Herman reference for 8 a.m. We're a Silicon Valley firm, though, so most of our investments and most of our companies, I'd say 2/3 of them are in the Valley. That we're in Palo Alto. The firm that my partner and I worked at before was 500 Startups. So that's a Silicon Valley based accelerator. A lot of Series B and Series A stage companies. Over the 3 years where I was the managing partner there, we were doing 400 to 500 investments annually. By the time I left, that firm had over 2,500 investments, all early stage. And most of it was software, a lot of SaaS companies, a lot of fintech companies, a lot of e-commerce companies. That tends to be where we invest. much of my career was at PayPal. I was there for 10 years and ultimately ran finance for them and then worked at eBay. So a lot of my expertise and experience has been in fintech and SaaS, but we've generally broadened out to any kind of software, any kind of internet distribution model. Those have been the companies we've been very successful with. And then a couple of years ago, we started Practical Venture Capital, again in the Valley, but with a global remit. And the idea there was to create a secondary firm. And what we have concluded in looking at the market at that time is that there was a big opportunity in secondary transactions, meaning if you think of the life cycle of a venture capital firm, I'm just sharing my screen so you can see how the progress goes in a well-run venture capital firm. On the left-hand side is what happens at the early stages of venture firms. You make a lot of Series seed to A stage bets. Those are the red circles there, the red dots. It just represents a whole lot of companies, a whole lot of activity. And if you're running a broad and diversified portfolio, what tends to happen is the companies that you think are going to win generally don't win. Oftentimes you're surprised by the companies that do win, and the portfolio begins to write off a bunch of its losers, usually in the first couple of years. The winners are emerging, but they're still not clear. You find you're pulling fees out of the fund, you're pulling management fees and expenses out of the fund, and usually IRRs are kind of depressed for the first 3 to 5 years, even for the best run funds. That's what we call in the industry the J curve. IRRs are lower up front, they begin to accelerate, and usually years 3 through 7, you begin to see some acceleration in the IRRs. And what that is attributable to is just you've written off your losers. The winners are now becoming a bigger and bigger piece of the portfolio. There's about a 50% graduation rate from Series seed to Series A, meaning half the companies don't make it, but half of them get a subsequent fundraising after that seed stage. Again, there's a 50% graduation rate from A to B, meaning that half the companies that even get to a Series A will never get to a Series B, but the other half do. And that's usually 4 to 5 years into a fund. And then you've got some more drop off into the Series C and beyond and so on and so forth. And by the time the fund is about 7 to 10 years old, you've got a small handful of winners driving most of the NAV. The IRRs are accelerating because they're following now the trajectory of the remaining companies. You're kind of over that survivorship bias problem. Most of the fees are pulled out of the fund. Most of the expenses are pulled out of the fund. That's usually a good time to be in that fund. The challenge is just liquidity. It takes a long time for these funds to return money back to their limited partners. So Mike and I, we met at Stanford, as Mike said. And when I graduated from Stanford, my first job was in Wall Street. Then I went to Harvard Law School. Then I went to PayPal. And PayPal was a company in that kind of Web 1.0, Generation 1 cohort where Yahoo and Amazon and eBay and PayPal were all public within 5 years of founding. So if you were an investor in those companies, you got your money back in 5 years, or at least shares. You can get liquidity. You may not sell the shares. You can hang on to them forever, like many of our investors did, but you had the chance to redeem those shares for liquidity in about year 5. That is no longer true. The big IPOs in the last couple of years have been Airbnb and Uber and Palantir. These companies are 14, 15, 17 years old between founding and when they go public. So there's a long, long time when you just don't have liquidity now from these late stage private tech companies. And a lot of LPs just can't plan 15 years ahead. No liquidity for 15 years is a tall order for limited partners. There are patient capital, university endowment funds, sovereign wealth funds that do a good job managing those types of time horizons. But a lot of the friends and family offices, tech entrepreneurs who are investing in their friends, they can't wait for 15, 17, 20 years and not have something to show for it in many cases. So they're looking to sell in or about year 5, year 7, somewhere in that period is when usually the limited partners start to want to get out. And that's what we like to do is we like to then buy in when the fund is about 5 to 7, maybe 10 years old, with good companies that we can underwrite, and we like to create liquidity by buying out this early LPs. The benefit for a investor in one of our funds or a secondary fund is that you will have a much shorter window to get your money back. So the red line on this graph is typically what a VC fund will see today, like how fast you get your money back. What we tell investors in our traditional funds is after about 7 years, we're projecting you'll get 0.5x back. And then after about 12 years, you'll get between 1 and 2x back. And it turns out, if there's upside and the fund's doing great, expect most of that to come back after year 12. So you have to have a long, patient time horizon. The green line is where secondary funds are. You have a much faster return of principal. We're targeting 1x back in about 2.5 years. And then by year 7, and we have 7-year funds, which is a much shorter term than most venture funds. In year 7, we're expecting 3 to 5x back. So that's how we underwrite the plan. And that's what we've been telling our investors. So you will get you'll have your money back within, let's say, 2.5 years. You'll make all your returns within 7 years. Then the fund life is over. There may be some extensions and some liquidations, but that's the lion's share of the distribution. So it's a much faster time to return profile than what you would typically see in a traditional venture fund. And that's a big benefit of the secondary market. And just the fact that companies are taking longer and longer and longer to go public now means that I think this trend in secondary and in venture and in private equity is here to stay. And in fact, it'll be getting a lot bigger over the next 5-10 years.
Yeah, absolutely. It's so funny. I can remember 20 years ago, people used to say, if you haven't gone public or had some kind of an exit within 5 years, it probably wasn't going to happen for you. I mean, it was very binary. You either hit and popped and exited within 5 years, or it was probably a miss. And that's something that's changed quite a bit from the PayPal days. It's interesting. I should have mentioned at the outset that Iman was part of the PayPal mafia. I reconnected with him recently at a little reunion party that was held for PayPal. I was never actually on the PayPal team, but I crashed the party anyway, since I know almost all the people who did work there. And I wasn't hired by those people then, but I was hired for subsequently for other endeavors that they had afterwards. And of course, the story of PayPal is obviously a great story of how that company succeeded despite the odds. But the story just keeps continuing because all of those people who sort of were forged in the crucible of that extraordinary company that basically made its bones during the 2002 period, which was obviously not a good time in Silicon Valley for most companies. They've gone on to do incredible things, as has Aman, of course. But getting back to this question, liquidity has become such a problem, not simply because the time horizons have expanded so much in some of these startup companies, but also opportunities for exits are getting more constrained, particularly in the teeth of this relatively choppy market that we've had over the last 10 months or so. I mean, the IPO scene is a little quiet, understandably so. Who would want to IPO into the teeth of this market, particularly with the onerous disclosure requirements that are required? And that's a lot of work to IPO, as I'm sure you remember from the PayPal days. Yeah. And that's why during the really hot period, that sort of stimmy fueled bonanza that went on between spring of 2020 and say around November of last year, a lot of people eschewed traditional IPOs for these SPACs. That was a big thing. A year ago, people couldn't stop talking about SPACs. Suddenly, I don't hear about them at all. And obviously, M&A is a ticklish thing to do in this market, particularly with Lena Khan and an activist FTC scrutinizing every deal with a fine-tooth comb. So venture is clearly having a liquidity problem that these secondary, particularly the GP-led continuation funds or vehicles, can help solve. Now, you've watched this market mature over the last decade or so. Right. Tell me, I mean, we're now doing something on the order of about $100 billion a year in volume in secondary markets.
Yeah, in the private equity space, that's let's say alternative assets, privately held companies. That's probably about right. I think this year will be a bit slower than last, but that's
right.
That's
and we might have even hit 120 billion last year when the last really hot year. And we recently had a couple of people on from PJT Partners, Gordon Appel and John Jufra, who were very bullish on this market over the course of the next 5 to 10 years, seeing it perhaps at least 2x and probably it could go 4 or 5x. Do you concur with that bullish near-term assessment?
Yeah, I think so. Let's take the private equity market as an analog. So if I go back to like 2000, when you and I met at or around
excuse me,
Stanford campus, and our colleague Peter Thiel started PayPal. Mm-hmm. The secondary market there wasn't as much of a need for the secondary market because the MO for companies at that time, let's say 1999. was start the company, raise the money that you need. If you can get to the public markets, in that 1999, 2000, 2001 frenzy, then A, you can raise capital at a low cost of funds, and then B, all your investors are liquid, so they can cash out, and that's really important because early investors need liquidity in a reasonable time frame. Employees need liquidity. Like if Peter Thiel had said to me, "Hey, here's some shares in PayPal," they're really, really, really valuable. You young college graduate who just graduated with at that time had $32,000 in debt, which sounded like a lot of money back then. But the average graduate now probably has $300,000 in debt, and hopefully they majored in something important like economics and engineering. But if they've majored in creative writing or whatever you majored in, I suspect that bill is going to be even tougher to pay.
It was English Lit, and thank you, Mom and Dad, for paying for all that. I didn't graduate with any debt. I was a very privileged person. Thank you very much. But the reason I was allowed to major in something like English Lit is because I wasn't taking. I'm sure if I'd taken out $300,000 worth of college loans, I would have found a more practical major.
Right. So when the startup comes to you, the English Lit major or whatever you are with a lot of debt, you say, here's some stock options. The stock options are valuable. I promise they're really valuable. We're going to pay you $50,000 a year, but these stock options will be valuable someday. On average, Airbnb, Palantir, Uber, you can count on cashing these in 12, 15, maybe 17 years. How does that sound? A lot of these college graduates be like, well, I can't work for $50,000 in salary, have a place in the Bay Area or in Austin, maybe plan a family someday, maybe buy a house, maybe buy a car that I don't have to fill up with gasoline that costs $7 a gallon in Palo Alto, and they don't take stock options. None of the gas stations don't give you credit for stock options, so you have to have some kind of liquidity event. So a lot of early employees are looking for liquidity as well. So back in 2000, the MO was go public. Companies could do it. They didn't have the same SOX compliance overhead we do today. The public markets were accepting of .com IPOs, maybe to a fault. And so companies like PayPal were public within 4 years. The whole secondary market back then was only $10 billion. Fast forward to 2010, and now you had a different situation, a much tougher IPO market. The additional regulatory burden that you alluded to of going public as a former CFO, I know all about dealing with accountants and having to get an audit done for a public company ready company. That's not trivial. Then on top of that, you had Tiger and SoftBank and crossover investors now willing to invest in private companies at valuations at those later stages that are pretty good and cashing out certain employees along the way. So now the private markets are solving for what the public markets alone were doing. And the secondary market becomes a much better, much broader, more efficient liquidity solution. So back in 2010, the private secondary market was about 25 or 30 billion. So, 3 times bigger than it had been in 2000. Well, now the markets is at $100 billion. So now we've quadrupled the market again in the last 10 years. And again, the same dynamic of public markets are tough, IPOs are scarce. M&A can be challenging, but all those liquidity needs for early investors and employees haven't gone away. So those private sector markets are filling in. I don't think there's any reason that and now we're seeing that happen in venture. So private equity has set that 20-year trajectory. We saw that in real estate as well. Real estate asset class has now a very active secondary market for funds and fund interests. We've seen more REITs that have gone public and created those liquidity markets in the public venue. Now we're just seeing venture beginning to catch up. Same dynamics. It's gone from a very nascent market, really non-existent 5 years ago. Now we're doing it. Industry ventures is doing it. Collar Capital, Greenspring are doing it for later stage funds. There's an organized effort around the continuity vehicles and end-of-life funds and GP-led secondaries. There's much less stigma now around secondary markets and trading than there was 5 or 7 years ago. Better understanding. So I think all the momentum continues in favor of growth of the market, and I wouldn't be surprised if it 3x, 4x, 5x, 10x in the next 10 years. I can see this being $1 trillion asset class over the next 10 years because of all the factors that are listed.
Excellent. And Aman, I'd just to go back a little bit to the strategy that you're employing at your fund. Are you today? You're mostly focused on buying LP positions in venture capital funds. But you mentioned some of the other tools that are being used, particularly in the private equity space, continuation vehicles, GP-led restructurings, things like that.
Yeah.
Are you employing any of those sort of almost like sort of financially, financial products in the venture space as you see it? Because I think we've seen a lot in venture.
Yeah.
Some of the reticence as well as sort of a secondary topic, but some of the reticence maybe to even see venture really accelerate in the secondary market is some of the stigma around negative signals with a VC general partner selling a portfolio company. So maybe how you think about in terms of buying either secondary directly or using some of the learnings from the private equity space to sort of engineer an outcome.
Yeah, we are using a variety of tools. Let's talk about this stigma for the second and why it exists, and then where I think it's applicable. If a fund manager came to me who was 5 or 10 years in, had just been running a micro venture firm, has made investments but they're liquid, and we think the company's doing well, and we think the underlying assets are performing, and that general partner says, "Hey, I want to sell 100% of my economics of the fund." That would be a warning signal for obvious reasons. Like a general partner has to be aligned with their limited partners. We don't ever want to change that dynamic, and there should be no good reason for a GP or a founder of a company to sell 100% of their stake while they're still running the show. So we don't do quote unquote GP led secondaries or a restructuring of the firm. That's just not the business we do, and so we're letting others like Industry Ventures or Greenspring or Collar Capital do that kind of work. The dynamic that we do like is a GP has been running a fund for 5 to 10 years and says things are going well. We haven't made distributions because these companies aren't liquid. The management fees are barely paying my salary. I'm married. I got kids in school. I've got kids in private school. I want to buy a house in the Bay Area or in a hot market like Austin, and or I'm raising fund 2, and that takes time and effort. But I want to be able to raise. In order to raise fund 2, I need some capital, just fundraising, organizational expenses, all this other stuff that is required in fundraising and hiring people and everything else. And I want to sell 10%. I want to sell 20% of my stake in fund 1 in order to finance what I need to do for my business, or take some money off the table so I can buy a house, so that my wife and kids aren't mad at me, because happy wife and happy family is happy life, and we all understand that. So we will typically then deploy. That's the kind of situation we like. We might buy a piece of the GP. We might lend against GP interests. There are different ways that are they're tax efficient or unique to different how to structure these things in order to be able to provide liquidity. And we'll do virtually anything that makes sense for the partners. And the private equity guys have gotten very, very efficient, very creative, and we're taking a lot of their cues as well, which is great.
Excellent. And to that degree, do you see also some of the continuation vehicles where can be employed, whereby you're buying and transferring assets from the GP to another GP affiliated entity?
Yes.
To control such that you can get DPI and sort of effectively divest capital for those LPs in a way to either help fundraising or any of the other things you mentioned, because that's something that we've obviously been focused on here, and we're seeing sort of the appetite grow for that.
Yeah, I think the it's starting to happen now, because a lot of the funds that are in that situation are probably 10 to 15 years old. So imagine a GP who's like, "Hey, I've got have a venture fund. 99% of venture funds have a 10-year life. Just have the lawyers have drafted these documents for, I don't know, at least the last 25 years. So if you go to Wilson Sonsini or Cooley and say, "Hey, draft for me a limited partner agreement, just give me your standard boilerplate default agreement," 9 times out of 10 it'll have a 10-year term. So if you started a fund back in 2012, you're at the 10-year fund life right now. You may or may not have made significant distributions, and you got to figure out what to do with your LPs now. If you're raising a second fund, those new LPs will be looking for a track record, and the number one thing you look for in track record is, hey, what's your DPI? Realized gains, what was distributed? And if your answer is 0 or less than 1x, that's just a tougher message to take on the road for fundraising. So a lot of GPs are rationally saying, well, I'm at the 10-year end of my life. I need to show some distributions to improve my track record to then raise my next fund. How do I, but these companies are illiquid. So how do I take credit for all the great investments I made? let me transfer it or sell it to, some other affiliated vehicle or some other, some other vehicle that we can agree on with a third party or some kind of arm's length price. That's not a business I think that's a booming business and it'll do great. It's probably not where we focus. That's more the last 10 to years, 10 to 15 on a fund is where that happens. We're more like years 5 or 10. So we're looking for funds that are still that are in companies that are growing very quickly, have I think more growth than runway and opportunity because they're less mature, but also higher growth than those end of life type companies and funds. And where the LPs are just looking to hit the eject button, like they're into year 7 of a fund, haven't gotten any distributions. They're not at year 10, so they don't have any legal recourse to get their money back. But life stuff happens in year 7, and so if you there's a change in the death or divorce in the family, change in your investment strategy or portfolio, you're a corporate LP who's shifted interests. Those types of situations happen well before year 10. That's where we play, and I think that's a bigger greenfield opportunity than the later stage stuff, which is also interesting, but just not our cup of tea.
Yeah, I think that all makes a lot of sense. It's a lot of attractive parts of the market, but I think particularly where you're looking for maybe a 3 to 5x, that point in time, at that inflection point, at that sort of 5 to 7 year mark is obviously an important one.
Yeah.
Yeah, you talk about the stigma. I mean, one of your partners at PVC has likened getting into some of these secondary investments as buying the winning ticket at halftime, right. Which I love anyone who relates anything to football because then I understand it much better. But, I think that is why these investments are so attractive for a lot of, family offices, high net worth individuals, people in private equity. But it may also be a reason for why there was this stigma, because these VC people who come in at the seed stage, they look at these companies as their babies. They're nursing them from birth. Gordon Appel, when we had him on a couple of weeks ago in episode 2, mentioned that there was one of the difficulties in getting these VC deals done in secondaries is that there's often a large spread between the bid and the ask. What the VC thinks it should be worth doesn't necessarily comport with what analysts would determine as the net asset value, which is there's usually a discount to the net asset value in a secondary transaction. We saw during the big run up in 2020, 2021 that many of them were not discounted to net asset value. In some cases, people paid a premium. Obviously, that's changing. But have, in your experience, being based where you are, right in the beating heart of the VC world, you can probably throw a rock and hit Sand Hill Road from where you are if you're not on Sand Hill Road yourself. And okay, has that factor? Have you heard people express that kind of point of view that these these Johnny-come-latelys are and obviously they don't have the luxury of that kind of prejudice anymore because of the situation that's now prevailing, right? They have to be, as you say, they've got to keep their employees happy. Their employees can't eat stock certificates. I don't care how much hot honey you pour on it; it's not going to be tasty. They've got to keep their LPs happy, who are individuals with very different time horizons in many cases than what a big pension fund or a university endowment has at their disposal. The people running those institutions are less important than the institutions themselves, which are going to endure. I'm not sure in some cases they should, but they will. For individuals, a 15-year time horizon is just too long. It precludes people of a certain age from participating in this sort of thing. So, yeah, I mean, don't you think it's simply a matter of the stigma's ending because it must, because it's undermining opportunities for VC in getting some liquidity, getting an exit that might not otherwise exist.
Yeah. I think there is some the stigma or the hesitation on the part of some of the sellers. Much of it has to do with let's call it recency bias and maybe just a reflection or a reaction as to what's my baby worth. That ownership might be stronger for a general partner who just doesn't want to sell their winners and and wants to get the price that they've seen it trade at, or where there was a recent price round. Limited partners maybe look at their financials, saying, "Why, if the thing is worth $300,000 on paper, why are you only offering me $200,000? That seems like a 33% discount to what it's worth, quote unquote." And here's just the challenge between public and private markets. So this chart shows you where all the publicly traded SaaS companies in the U.S. have traded on a EV to LTM multiple basis for the last 8 years. So as of the end of Q2 2022, that whole basket was about a 8x sales multiple. And we've talked about tech getting beaten down, and the stock market's down, and everyone's feeling like there's been a beat up on tech valuations. But if I just measure the SaaS portfolio based on sales multiples, it's at about 8x right now. Q1 of 2020 was about 8x. Q1 of 2019 was about 8x. Q1 of 2016 was about 6x. Historically, it's been in this range, and so 8x is really not that far off of the 5 or 7 or 10-year mean for SaaS multiples. So why do we all feel crappy, like the tech valuations have been unfairly beaten down in public markets? Well, look at where we were from Q2 2020 to Q4 2021. Those multiples were up at historically high levels that we've never seen and probably will never see again, between 15 and 17x. So everyone's got the recency bias of like, hey, my stuff is worth 15x or 17x, not 8x. So why is Aman or Mike offering me a 50% discount to where these things are traded? No, my answer is, look, in the public markets, everything's been cut by 50%. So if you raised money in 2021 and set your valuation based on what SoftBank or Tiger financed you at, you just got to throw that data point out. So that is no longer representative of the reality. You got to go back to reality, which I think is really what's the 5, 7, 10-year like trailing, median multiples. Like that's how the public markets have very quickly, I think, come to Jesus. In the private markets, this stuff takes a long time to react. So here's an example of how private and public markets track. This little blue line is a chart showing the median Series A U.S. round size. When a company raises a Series A in the U.S., what's the round size, and usually replication, what's the valuation? And the line's been going pretty steadily up and to the right for at least the last 8 years. Those red banners are the NASDAQ corrections. There've actually been 5 of them in the last 10 years. That's the NASDAQ dropping by 20% or more. And you can see what happens to the blue line for these early stage companies when these corrections hit. It often corrects by a little bit, but no, not by 20%. And there's usually a lag. So it doesn't happen right away. So there's going to be a little bit of a lag between what the public markets do. It's usually 6 or 9 months, and then the blue line begins to fade down. And it's not quite, 1 for 1. There is a very high correlation, but it's not quite 1 for 1. In this latest NASDAQ correction, we really haven't seen Series A valuations drop at all. Like companies that are financing right now are getting the same pricing or pretty close to it as they were about a year ago. In the later stages, like Series D, here's the same line. Here you can see the blue line usually tracks pretty quickly. So if there's a NASDAQ correction, the late stage Series D stuff drops pretty quickly. It happened in 2015 and 16. 2018, kind of sort of. 2020 for sure, there was a late stage correction, and now we're seeing a late stage correction by about 15 to 20%, and I think that'll continue to happen. But there's a lag in how these valuations, the private valuations, catch up. So it's not 1 for 1. So I think what will happen is, reality set in on the public markets in kind of Q1, Q2. Interest rates are higher. The Tigers and SoftBanks are out of the market. So now there's going to be a correction in the second half of the year, down rounds, write-downs. Probably at the end of the year, auditors will start to dig in on all these financials and start to force some of the larger GPs to set to the new market reality. So there'll be some additional cleanup at the end of this year. That's when GPs will start writing off some of their losers. I think by Q1 of 2023, the private markets will have largely caught up to where the public markets are. And then I think with better information, some of that stigma, some of that anchoring, some of that recency bias, will begin to go away. So we're already negotiating good deals, but I think it's a tougher market to get good deals. We're being patient. We're kind of waiting until the reality sets in. And these numbers and down rounds will help. But when you tell somebody their baby isn't beautiful, you can show them all the data you want. There's going to be a little bit of a reaction and a negotiation until the person accepts that their baby ain't beautiful, and that's probably a 6 or 9 month ongoing negotiation.
So,
Yeah, I
Aman,
think that's probably right. A lot of people have commented on this. Bill Gurley had 4 words for all these people who don't want to look down. Say, look, forget those valuations ever existed. It is a little bit like those old cartoons where the coyote would run off the cliff, and as long as he didn't look down, he wouldn't fall. But as soon as he looked down, he would fall. And I think a lot of Silicon Valley people right now are just trying desperately not to look down. But as you say, the auditors and
keep running in
reality
there,
will
like coyote, and just they have that gravity hasn't quite set in yet, but it usually wins. Gravity usually wins.
Gravity always wins. I'm learning that at 52 years old. I'm learning that every day. But so, one of the other really attractive things about the secondary market, as I see it, in addition to, as your partner says, buying the winning ticket at halftime or skipping the less exciting part of the J curve, is the transparency of these deals. A lot of VC funds, traditional VC funds, early stage funds, they're blind pools. You're really betting on the GP entirely. And we obviously know a lot of people that we went to school with who you would happily bet on, right? Their track record it speaks for itself. And but there isn't a lot of transparency. It's a blind pool. Whereas you in particular are doing this co-investment arrangement with a lot of your LPs, right? Where they're writing alongside you, they're analyzing alongside you. It's very open kimono.
Yeah.
Talk to the audience a little bit about co-investments and your unique, because you obviously bring enormous analytical talents to this enterprise. So, talk a little bit about that for us.
Sure. We the co-investment program that we run is a little bit of it's a jump off of what we did at 500 Startups, and what we heard there from many LPs is, I want to invest in early stage venture backed companies. I don't really know what I'm doing. Unlike you guys, I'm not living in Sand Hill Road. I live in Saudi Arabia, or I live in Canada, or I make my money, I don't know, in real estate in New York, or playing poker in Las Vegas. Like, I'm not a venture guy. That's not how I made my my millions. But I want to learn what you guys do, and I want to see how you do it, and I want to kind of come along for the ride. So let me invest in your fund, but also I'd love to see your best deals, and try to get me into your best deals. A lot of VCs are very closed up about that. They don't want to share their best deals with anybody. They want to take all the economics for themselves. And that's a perfectly fine, VC philosophy. What we have found is that usually even for the best companies, there's a lot of potential opportunity to invest. And if we can benefit from it, great. But if our LPs can invest in it directly, great. A lot of early founders will take the additional capital. They give us allocation, but if we go to them and want more, they'll give us more. So we're generally of the school, if it's just better to share and do that with your LPs, and don't hog the economics and don't get difficult on the fees, because this is a long-term relationship game for us. Many of our LPs have been in multiple funds now for us. So we try to bring them along and educate them to the extent they want to be educated, and then give them access to the same deals that we're looking at. So we'll study a company or a portfolio. We'll work through our own diligence process, do the deal memo, and then share that with the limited partner and say to them, if you want to co-invest with us on the same terms, we can do so. We'll typically waive the fee for any co-investments. We'll often charge some portion of the carry, just so that there's some continued profit share for us. But then we'll try to get the LP in on the deals as well. And I think it's a great way for them to learn about venture capital, do it in collaboration with a team like ours that's done it before. Just can help provide them with deal flow and some of the analysis and some of the pros and cons. And usually our companies love it, because they will always raise money. They like to raise additional money if they can, and if we can introduce them to new investors, that's a win for the founder, a win for our LPs, and something we like to do in order to build our relationships.
Mm-hmm. And another point that Andy Nick of Jefferies Financial made in a recent interview he gave to PitchBook was that by being able to drill down into these companies, you can sort of recession-proof your portfolio a little bit. And I wonder, many of the big banks, Deutsche Bank, Bank of America, Goldman, are predicting a recession hitting the United States. Well, most of them predict it'll hit Europe in Q4 of this year and probably hit us early next year. Does that comport with you've always been very good at forecasting the future. You've made a lot of money wagering on a variety of things. But where do you see this economy going over the next 2 years, and how can continuation funds and other secondary vehicles help with not only helping people choose the companies that will ride out that recession most effectively, but also, of course, the key issue of creating runway, liquidity runway for to get to the other side of it.
That's an excellent question. So, one, I don't think I'm any better at predicting recessions than others. As you said in your intro, I did. I studied economics, and I love the topic, and I taught it at Harvard, and I'm teaching a class at HBS about Fed policy and monetary policy and some of the macro implications. So I've thought about a lot about it and read a lot about it, and so I'll share with you what I think and some of the rationale. First of all, I think in the U.S. we're probably already in a technical recession, meaning 2 consecutive quarters of declining GDP growth or economic activity. Now, most recessions don't have a 3.7 or 3.8%.
Right.
So it's an unusual recession, but at the same time, our labor force participation in the U.S. is at a 40-year low. So we have not had this small a percentage of kind of employable, age-appropriate workers holding a job since about the early 1970s. And there's a massive, labor shortage as a result. So we're already in a bit of a mini recession to begin with. I think it's inevitable that Europe slides into a recession, probably second half of this year or early next. They're much more dependent on imports and energy prices, and just the ECB has not been as aggressive in raising rates as they probably have to be. But now we're seeing inflation prints. We saw a tough one in the US today, but the UK is even worse.
They're in double digits, aren't they?
I think they're over 10% now and projecting up to 15% by the end of the year. Germany's not far behind, and we've just seen, very slowly but surely, Europe is really struggling now with energy prices and energy dependence on Russia. So it seems like all the economists that I'm reading are projecting a tougher time for Europe than the U.S. The U.S., I think it probably continues to get a little bit, tough into the second half of the year, just because the pace of the Fed rate cycles and monetary tightening will continue in the U.S. The inflation rate here is 8.3%, and the overnight, Fed funds rate, even with another base rate hike coming for the Fed, is going to be in the low threes after the next rate cycle. So real interest rates are negative 5%. Mm-hmm. And that's just not going to continue. Something has to give. We're not going to have negative 5% interest rates for very long. Either rates keep going up, or inflation has to keep coming down, or some combination of the two of those. So I think the monetary conditions keep tightening between now and the end of the year. What we generally have told our founders is that I think this is going to be a 12, 18, 24-month drought, just like we had in 2008, and before that we had that in 2001. And that means raising money is going to be really, really, really difficult. And I think the single best predictor of how does a company do in a recession is honestly just have a conversation with the CEO and the head of finance, and talk to them for about 5-10 minutes about how they're thinking about runway and preserving cash, and if they have the mindset of just becoming more operationally efficient and doing more with the money and cutting costs and being disciplined. Are they even thinking about profitability? Are they thinking about the bottom line? Are they thinking about cutting costs and scaling back? There's been more than one article, and it's kind of amazing to me that people are in the news for doing stuff like 7% layoffs, 10% layoffs. Netflix is making operational excellence and discipline, financial discipline, for the first time ever, apparently.
Yeah, so, I can tell you here in Hollywood, everybody's very disappointed that they're not throwing cash around. Yeah.
It's like, how do companies even survive for 5-10 years without, embracing operations?
They threw so much. I mean, they were like the Tiger and SoftBank of Hollywood. They were just throwing money at everything. They throw $50 million to try and get a movie Academy Award and, best makeup or something like that.
Right? Facebook and Twitter, just, like real examples in Q1. Look at their Q1 earnings report. Revenues are down. I think they were down 1%. Costs were up 22% year over year.
Unsustainable. unsustainable.
And I'm thinking, I was at PayPal for 10 years and ran finance for PayPal. And we had some very good years. I mean, PayPal grew a lot further and a lot longer. And we did just objectively much better in the top line than Twitter ever did. Much more valuable company. But if I'd gone to, my boss, who at the time was Bob Swan, who was the CFO of the mothership, eBay Inc., that bought PayPal. And Bob later on became CFO of Intel and then CEO of Intel. And I'm a great admirer of his. If I ever went to him and said, "Hey, Bob, here's the plan for next year. We're going to grow revenue at -1%, and we're going to increase cost, but we're going to increase cost by 22%, and that's what I want you to go to the street with your guidance and your report." Like he would have, he would have fired me, but two, he would have been disappointed in me because he would be like, "Well, I thought I taught you better. If your revenues are at -1%, like costs can't be at +22." You have to learn to manage expenses, manage costs, defer expenses. Laying off people, 10% layoffs. I mean, my God, there was a time when we would do 10% every year. Every company taught us, right? Like every year, no matter how far you grow, just do a bottom 10% riff. And don't assume that you get to hire back all those 10% people, because when you have too many people working on stuff, it's inefficient and it's not good performance management and all the rest of it. And somehow a lot of the Valley in particular has forgotten that lesson. So when founders come to me and they're worried about layoffs and rifts and operational discipline, and I can't grow as fast as they want, I'll just ask them things like, "Well, what's your LTV to CAC?" And if you don't know what I'm talking about when I say LTV to CAC, let me help educate you around those metrics. But you should know what that metric is, and you should know what your burn rate is, and you should have 3 things in your head right now that will help extend the runway and defer costs. Leases you're not going to sign, rental agreements you're not going to sign, employees you're going to defer. Like, just know that you have those chess moves ahead of you. So if you can't raise the money, or you can't raise it on terms that you like, your mindset has got to be, how do I get more with less? How do I just, fly coach and not fly business and cut all my travel expenses and figure out how to be more efficient? If that's not in their mindset, they're not thinking like that. And a lot of founders today don't have that mindset because I guess they've never had to have that mindset.
They've never been through it. They didn't go through the NASDAQ crash, or in some cases even the 2008 crash. They're founders by definition tend to be young, and they've only known up and away in terms of the broader market. I think this is another area where everybody's trying hard not to look down. I know our mutual colleague David Sachs has been sounding the alarm all year about this, and it's kind of felt like Cassandra. It's like, you guys really got to be tightening the bottom line. With regard to Fed policy, you mentioned the print we saw this morning, which was about 0.2 to 0.3 higher than analyst expectations. I think that pretty much guarantees a 75 basis point hike next week. But how much higher do rates have to go realistically? I mean, Chamath Palihapitiya has made this point on the All In podcast that when inflation is above 5%.
Yes.
It doesn't go under 5% until you raise rates to 5%. I remember hearing him say that and getting a lump in my throat, like, oh boy, we've got a ways to go then. He's an advocate for just lancing the boil and getting it up there and taking whatever harm. I guess it's sort of the Volcker approach. Yeah.
I mean, you don't want to go harder than you have to. Volcker did. I think Powell will do what he has to. I think Volcker did what he had to. It turned out back then, what had to be done was, actually was like 19%. I remember my mom opening up a checking account for me when I moved to Canada in the early 80s. And the overnight, I guess the savings rate on the checking account was like 12%. And the mortgage that we were paying on our house was 19%. So, hopefully it doesn't go to the Volcker era. Hopefully that's not what it takes. The other thing to think about with respect to the Fed, it's not just the interest rates. They do set overnight rates, but they don't control 2-year, 5-year, 10-year mortgage rates. So they only control some interest rates, but not all. What they do control is the amount of money in the system, their balance sheet. And this is something that most people don't know or don't really talk about, but it is actually the thing that they do that is more impactful than anything else. What they did for the first time ever back in 2008, in response to a liquidity crisis, they expanded their balance sheet, meaning they printed a whole bunch of money and bought treasury securities and mortgage-backed securities, in some cases some corporate bonds, and the number of assets in their balance sheet essentially went from zero to about $2 trillion. And at the time, this monetary easing, quantitative easing, QE, QE2, QE3, QE4 was seen as quite a new and innovative and interesting tool in order to manage the money supply. And in doing so, they were able to stabilize markets, create some liquidity, and there wasn't a lot of inflation, so they did it in a balanced way. In 2020, they just did this thing on steroids. They went from a $3 trillion balance sheet to about a $7 trillion balance sheet while we were in that COVID recession, which is like the red bar on the chart. Okay, we come out of the recession, right? In July of 2020, thereabouts. Does the Fed stop with their quantitative easing? No, they keep going for another 18 months. That blue line, the amount of money on their balance sheet keeps going up, keeps going up, keeps going up. Finally, in March of this year, they finally stabilized the money on their balance sheet, and they're just now beginning to roll off some of that money. So we are seeing a shrinking money supply. The M2 is shrinking for the first time. I've only seen the M2 shrink month over month like twice in history. I think the last time was 1933, and I think the last time before that was 1929. And so,
those are not good, good examples.
They're already tightening, and I think what they'll now do is they'll be let's keep tightening. Let's hope inflation keeps declining slowly. I think we're in for a year of declining inflation, so we're not going to get back to 2% overnight, but it could take a year to dig ourselves out of this hole. And in the meantime, they will keep shrinking the money supply. The long bond is still in the mid threes right now, so the market is sort of, I guess, betting. And I'm not disagreeing with what Chamath has said. I think historically that's probably right, that it's rare and maybe unprecedented for this rate easing cycle to stop south of 5%. But anyway, the free market, the efficient market right now is not betting on that. I think it's, with as flat as the yield curve is, it's sort of betting that this stops in the mid threes. And I'm not smarter than the free market. I'm not smarter than, bond traders who do this for a living. I think their intel is like mid threes is where we stop. And with the shrinking money supply, and a declining inflation rate, that will the base case scenario is that we kind of get into the mid threes by the end of the year, and then maybe by then the problem is largely solved. And then there's kind of a gentle easing off of that short term rate to kind of normalize the supply curve or the yield curve. I kind of think that's the most likely scenario. The 5% plus scenario is probably 30% probability, and that'd be much more of a bear case scenario.
Oh, well, it would be devastating for the market. As you say, they're pricing in mid threes. If they really do have to go to 5, then there's more pain in the near term. But that's yet another argument for runway, for companies to create it, and for venture capital GPs to create it by using these secondary vehicles that we've been discussing today. So looks like 2023 is going to be a very good year for PVC, and hopefully Emerge 9 as well. Because this does create opportunity to bring people to the table to make these kind of deals. Well, we're coming up on the top of the hour. I know you have other commitments in Austin there. You're not there to enjoy the music scene and the barbecue, although hopefully you get a chance to. You're there to take some business meetings. So we're going to turn you loose. This has been an absolutely fantastic hour with you. I feel like we only just got a little bit of a taste of the amazing brain of Aman Verjee. We'll definitely want to have you on again to educate our audience some more about these things. You're the first guy that's come with charts. I respect that. And I feel like I just took one of your Harvard economics classes, and I'm going to have to now go and kind of absorb everything that you presented to us today. You dropped a lot of knowledge bombs. We appreciate it. Thank you so much. I'm so glad we reconnected. When I saw you at the party and I realized what you were doing, I knew we had to have you on here, and you certainly delivered today. On behalf of Alex Goomer, who's with us here today, and Aman Verjee, this is Michael Newman, host of Emergent Investments, signing off. Thank you for joining us today.